Writing an angel check is easy. Knowing why is the flex. Angel investing. Underused, misunderstood, explained badly. Angels Decoded, an educated and raw take. In cahoots with Play Money. Because, come on, Andy, last week you told me a company you're working with does 40 million in revenue. Turns out the real number was 10 million, and that was actually more impressive.
Well, revenue is what comes through the books, right? There's gross profit and there's net profit, and it goes down the line, right? But reporting of what you're actually doing needs to be contextual and relevant based upon the audience you're presenting it to. You can't manipulate the narrative.
You should never manipulate the narrative. And most founders don't. But when you come in, and particularly as a new angel investor, you see all these revenue numbers and terms thrown around. And one of the ways to make angels super accessible is just explain some of those terms so you know what it is you're looking at and know what questions to ask.
Absolutely. And between friends, it wasn't a posture. So I can't believe that we started the episode with you tearing me down. Thank you.
No, you actually told me about an amazing company with some amazing founders. And because I've been around a minute, I knew what to ask you about that revenue to get to the real punchline and understand what a strong business they were.
And they are amazing founders and doing great work, and they are going to join Play Money, funny enough.
So crazy.
Yeah.
But let's explain to people. I want to explain to people why you could tell me 40 million and the actual number could be 10 million, and why both of those things could be true at the same time. And this is like, this situation is one of like 3 patterns I see come up in understanding revenue for angels. The situation you were talking about, the company you were talking about it's a marketplace business, right? They facilitate a transaction between a payer and a service provider. So that $40 million in their world was the gross marketplace value. There's $40 million of commerce exchanging hands on their platform. The 10 million came because that's their, what we call in angel investing, take rate. They get a percentage of the money that passes through their platform. That number is actually their like real revenue that hits the books and that they can use to build their company and pay their people. And to grow. And you hear about these kind of businesses all the time. Technically Play Money is a business like that, right? There's money that moves through us for investment to go to the company. And then we've got our fees that are a piece of that. So it's super common, but it's definitely something that will trip newer angels up.
And the common sense approach of revenue is top line coming in, but then you have a cost of good. And in this instance, the cost of good is the bulk of the payment that's a service that's going to somebody else, and you're taking a percentage clip of that on the way. So your net profit is a smaller amount. And those two numbers can be very different in this instance, like worlds apart. So understanding those two levels is based upon the type of business model that the company runs, and then specifics around how they operate and then how they drive revenue off that business model.
Absolutely. And so for marketplace businesses, it works just like we were talking about there. GMV, gross market value, which is usually a very big number, and then take rate, which is the company's, monthly or annual revenue, which is usually much smaller, and that's expected. In other businesses, you can look at that $10 million as like the margin, right? In other kinds of businesses, you've got to poke into that margin a little bit better. So like the second revenue thing I think it's important for people to understand is to really look at the unit economics of that business. And this is becoming more important with AI. And look at it and say, so do the costs of this business scale right with revenue over time? Or do they stay a little bit fixed? So the more volume the business does, the higher their margin and higher their profit is. And this comes into play, again, it comes into play a lot with AI, right? Like, good, my top line revenue is growing, but I actually use up so much AI computing power that my costs are growing right along with that. I am not getting any more efficient as a business as I grow. Whereas most businesses, especially venture-funded businesses, are designed to get more efficient. You've got a certain kind of fixed cost, and then the more you sell on top of it, the more money you're making. You're making a lot more of that fixed cost.
And in a traditional business, it is a common pattern of revenue, cost of goods, and then you have net profits. Then you have your OPEX, which is all the cost to run your business, and then ultimately an EBIT number at the bottom.
Oh, you're hurting me. You're running, which is all true. But as an angel investor, if you go looking for those numbers, you will not see them because the companies are so early and whatever those numbers are meaningless. What you're really looking at is truly that top line growth number and what it means for the money coming back to the company and how predictable that is over time. Right. And so it's a much more it's a simpler set of analysis if you know what to poke on.
Absolutely. And there was no trickery in what I was saying. But the case now, and one simple example, AWS credits. For people that are getting a whole bunch of free credits that don't show up as a cost yet, and then all of a sudden drop in. And our forecast is that all of these credits are starting to go up in price, not down. And that is going to change the business model in the future. So trying to understand unit economics in the world we live in today, it feels like a finger in the air type activity.
I don't know if it feels like a finger in the air if you know what to ask, right? If you know the GMV and take rate question, if you know just give me, unpack those unit economics a little bit. Are they scaling with your revenue or are they staying fixed? The piece that I think is where the most confusion is arising. And I'm avoiding talking about Amazon credits because I had a founder come to me the other day considering them investment. She's like, Amazon invested $120,000 in me. I'm like, did they? No, it was her AWS credits. I was like, sweetheart, no. That's not how this works. But we will skip that story. The third place I see revenue getting confusing and the angel should be able to ask the right questions around it are around what I'm calling the two ARRs. So ARR, it either means annual recurring revenue, which means you've got someone on a subscription and they're signed up and they're going to get billed that same amount every year or, every month, monthly recurring revenue to add up to a year. ARR can also stand for annual revenue run rate. The users aren't on a subscription. They don't auto renew. You have to do something to earn their business year over year or month over month. And those terms get confused all the time because, I don't know, someone gave them the same 3-letter acronym. And it's sort of up to you as the investor to say, what kind of business model are you running? Is it a subscription business where you just need to retain people, or are you earning their business new every month? Like, again, Play Money, for example, I need a user to invest to make revenue off of them. That's not a subscription. I am earning their business every month. They need to find something new they want to buy with me.
The way that those two terms get interchanged is a problem, right? Because on a traditional AR, annual recurring revenue business, like a SaaS model, you can forecast with a relatively level, high accuracy based upon your churn rate. So the customers that use your product and then drop away, you have a percentage. That is a pretty consistent number you get from a founder. And then you start to look at lifetime value. So the longer you're in market, the longer you get a sense of how long that customer stays on for on average. And that allows you to look at the foundational numbers that you can forecast sometimes years ahead. And then the acquisition cost to get new customers or retain customers is the part that changes year on year. But then you're getting into the weeds. And a lot of these terms, if you're an early angel investor, it's hard to know where to start and where to stop and how deep you need to go. So in that structure, what are the things that you would suggest an angel investor is looking at with some of these terms? And what are some of the loaded or transparent questions you should be asking to get a sense of that unit economics in their business model?
Well, I actually think we've laid them out actually pretty clearly here, right? Is that revenue model you're giving me, if the person's running a marketplace business, is it gross marketplace value or your actual take rate? That's one question to ask. If their business model is, if they're talking about ARR, ask them, is that recurring revenue on subscriptions or is that just your revenue run rate? And then the third question is ask about what they're seeing with the unit economics. Are their cost of goods staying sort of flat? And so every net new sale they have has a bigger margin, or are those costs growing in lockstep with their revenue? Those three questions will handle 90% of the things you'll see as an angel. And it's the right level of fidelity to understand the business and the traction numbers you're seeing.
Okay, so AI businesses are the anomaly. But this feels a little bit Wild West. So from a revenue perspective, different stages of companies, it's different. But what are some of the things you're seeing founders do with their revenue numbers who are operating AI businesses? Like $120,000 investment from Amazon is a free credit that's a loss leader for them to get you to spend a whole lot more with them in the future, right? It's
Yep.
an acquisition tool they're using. It's
Yep.
not an investment. So from a founder perspective, like what are the things that they're doing to make sure that this is clear and they have the right information?
If all the AI businesses we're doing right now was talking about $120,000 of like funny money, we'd be in much better shape. But they're putting like lots of zeros on the end of them, right? I mean, it's not uncommon right now to see a headline of, company XYZ went from 0 to $10 million in ARR in 6 months or 100 million in 9 months. And like your mind is blown. You're like, what's going on here? And that's why we're talking about this now, because they're living in this funny zone. If you unpack those numbers, you're seeing a few different things. And this isn't true of every AI company, but it's great to be aware of this as an angel of what's going on in some of the revenue reporting. And we're seeing 3 different things happen. First of all, they're dressing up their run rate. So you have one really great month where increasingly we sold $1 million of the product on day 1 because we sold it all to our, Y Combinator cohort. So we're going to take that $1 million on one day and we're going to multiply it by 365 days a year. That's our annual run rate. We're awesome. That funny business is happening. So if you're seeing a company whose numbers look too good to be true, just ask, what is that run rate? What is that based on? The second thing I'm seeing, and this one I didn't see coming, and I watched someone break it down and talk about a few companies that was doing this and my eyes went wide. They're setting up multi-year contracts. So 5-year contracts. The first year is free and you can cancel anytime, but year 5 is $10 million. So they're saying, oh, we've got, $10 million annual run rate from this contract. No, that's not true. No, that is not true. It's a new way to position a free pilot. The company's using it for free, but they signed this thing. How the company should be communicating that is contracted revenue, which would teach you as the angel to push in and tell me about that contract. But they're not saying contracted revenue, so people don't think to ask. So that's the second AI trick. The third one is selling AI compute power at a loss. So there's a lot of companies that are like, we grew to $10 million, in revenue in 3 months. Yeah, they did it by reselling $20 million of compute power. So no wonder if someone paid them $10 million. They're getting, it's like a BOGO half price off deal on, Anthropic credits.
And the third one is what I'm seeing a lot happen already,
Right.
is that the revenue looks good, but the costs are so high that they run out of cash so quickly and they hit a cliff and they're desperately trying to find fundraising. And we just saw Anthropic close $65 billion in fundraising at almost $1 trillion valuation. And they're going in the right direction, but only a handful of companies are in a position where they can actually command that level of investment.
And it's interesting that you bring that up because you say they're trying to figure out, you can say that some of those smaller companies are trying to figure out their right revenue model, but this is a unit economics thing. If you're losing money on that core compute power, what are you doing to use less of it over time? And don't be a damn fool. The cost of that compute power is going to go up. Like what's happening with AI is no different than what happened with Uber or those meal delivery services. They were subsidized by VC dollars in the beginning. And the minute they weren't, you're like, why is it taking me $200 to get from the airport to Midtown when the plane flight only cost me $100? And that's what's going to happen. So especially with AI, it's a little bit of buyer beware or be smart to ask the right questions so you're informed.
And I remember some accounting 101 in my first business of cash versus accruals, which is similar to what you're talking about with contracted revenue,
Yep.
right? Like cash is money in the bank, accruals is contracted revenue, but if there's no actual inbound on that and it doesn't convert to cash, all of a sudden there's a huge void in your financial reporting between accruals and cash.
Absolutely. And again, all of that is true. And I am a numbers geek like the best of them. You don't usually need to go that deep as an angel. there's usually not going to be new stuff you see at that level. You can keep it at the level we've talked about and just ask those questions out to feel the shape of the business. And I would say to feel the shape of the founder. The reason I think this issue is so important now is because obviously to write a first angel check, you've got to know the basics here. But great founders who are super honest and super transparent and building businesses the old fashioned way are getting slammed a little bit right now because the headlines coming out of AI and the VCs there are so mind blowing that if you believe them all to be true, you're not going to fund, 90% of the businesses out there because they work like real businesses. We earn the revenue over time. We find product market fit. Things compound. We don't wake up one morning and have $100 million in revenue right there. I mean, if you're really making $100 million in revenue, why do you have to raise all that VC money? Interesting.
Unpick that one a little bit in those early questions.
Anyone can do it. They're not hard to ask and figure out when you know what you're looking for.
It's connected, but this is more my curiosity. That revenue and those early stages, how's it impacting valuations and the allocation of shares and what you're getting as an angel investor? You need to understand that because however they're calculating, like whether there's FMV done formally, whether it's just a guess.
Man, you're going to try to kill us with accounting terms today. Fair market value. Like, dude, I went to MIT for business school. I don't know if I could calculate that off the top of my head. You're playing today.
Well, it's important, but
Yes.
ultimately the advice that you would give an angel when they're looking at the AI category specifically, what are the things that they should walk away with today?
You know what? I'm going to say this as an angel looking at any category. Understand the basic questions on revenue. We just went through 6 of them, and those are probably the 6 most important. And then dig in. Don't let not understanding these things stop you. And it's not that high of a lift to know what to ask for. You don't have to go that deep. So that's how you build your identity as an investor. Learn a few things new every day.
Ask around. One of the great things about Play Money is that peer-to-peer learning as well. There's a lot of folks who have done it longer and have learned some lessons, both positive and negative in that space. So it's a nice way to connect with other people and glean some good insight.
Yes, we've got plenty of people that ask these questions publicly of the companies. So we get answers that we can share with everyone else. And folks have said one of their biggest values they've gotten from the platform is learning from other people's questions. And that's a great way to do it. So thanks for mentioning us.
Anything else you want to share today?
No, just buyer, be educated. It's not as hard as you think.
I learned a quick lesson. Careful of the stories that I share with Cheryl Kellond that I turn around and become an episode in the future.
Everyone on the outside's worried about that, but it happens right at home. You were right. Amazing.
Cheryl Kellond, another great episode, number 17 of Angels Decoded. I'm Andy Walsh from Startups Decoded. Cheryl Kellond from Play Money. What a treat.
Catch you later. Bye.
Angels Decoded, a weekly podcast for people learning the craft. Angel investing made easy. Subscribe, then decide. Angels Decoded, in cahoots with Play Money.